Good afternoon, I'm Valerie, and today, together with Ying, Zheng, and Wang, we are presenting to you our analysis of Samsung Electronics. This is the overview for today's presentation. Found in South Korea in 1969, Samsung Electronics is a flagship subsidiary of Samsung Corporation. This is the mission and vision of Samsung Electronics. Samsung Electronics has four main business sectors, namely consumer electronics, IT and mobile communications, semiconductor, and display panels. These are some of its key milestones since its establishment. Next, we have the SWOT analysis. Over the years, Samsung Electronics has gained a strong market position, and this is further backed by its advancement in mobile communication devices. Additionally, even while fierce competition is ongoing, Samsung Electronics was the main supplier of display panels to Apple. Although it is strong in many areas, it has its weaknesses, with one of it being the reliance of Android for its mobile communication devices. Furthermore, it is often involved in litigation lawsuits, which are time-consuming. In analyzing the external market, Samsung Electronics will continue to grow as the percentage of smartphone users continue to increase exponentially. With its wide range of products that is able to cater to various income levels, it definitely has a competitive edge over others. Its ability to jump on the bandwagon with regards to the latest technology will continue to help attract more users. With the opportunities in the market, Samsung Electronics would face intense competition in the saturated market. Additionally, the current global smartphone users has reached an all-time high of 1.75 billion, and smartphones are becoming a commodity. They would soon reach a stagnant stage in terms of improvement. As such, Samsung Electronics may have to resort to competition based on price.
We will first start with the choice of model. Samsung retains 92.4% of its earnings for its daily operational activities, capital expenditure, as well as R&D purposes. Hence, the dividend discount model will not be able to accurately reflect the value to equity shareholders. Based on past data, Samsung's leverage ratios have been relatively low and stable throughout the years. It has reached 8.8% for the last 12 ended June 30th, 2014. Correspondingly, its interest expense and debt repayments are insignificant. Therefore, both the FCFF and FCFE models will be appropriate. On another note, our team has selected FCFE model as our main valuation model, as our recommendation is targeted at existing and potential equity shareholders. We deem FCFE as a more direct and relevant model than FCFF. Samsung's relatively low stable leverage will make future projection of FCFE less volatile and more reliable than its industry peers. Now we will move on to key assumptions for the quarterly earnings forecast. We assume different growth rates for the four main revenue segments. We assign 60% weight to the last recent 4 quarters and 40% weight to the 4 quarters before that. Growth rates of more recent quarters are believed to be more representative of future growth. On the other hand, we forecast expense items as constant proportions of revenue. The ratios have been stable throughout the years, including an average of 62.7% of revenue for cost of sales and 6.2% for net R&D expense. The insignificant line items constant for simplicity's sake, namely share of profits of associated and joint ventures at 0.14 trillion and profit attributable to non-controlling interest at 0.12 trillion. Income tax expense is tied to profit before tax at 20.2%. Now we move on to the key assumptions for the yearly FCFE forecast. We use the formula FCFE equals to net income minus net capital expenditure minus the change in non-cash working capital plus net debt for our yearly forecast. 3-year CAGR 12.3% is used as the growth rate for non-current asset. And PPE, intangible assets, depreciation, amortization are tied to the non-current assets at fixed ratios. Change in net working capital is tied to the total revenue at a fixed rate of 2.4%, a simple average from 2010 to 2013 ratios. Net debt is assumed to be 0.7 trillion per year after normalization. Here is the overall representation for the yearly FCFE forecast. And here is the representation for FCFE valuation. We are using a two-stage growth model for this valuation. From 2015 to 2019, we assume a growth rate of 7.77%, a multiplication of retention rate, and ROE. After 2019, we assume that Samsung will grow at a constant rate of 3%, South Korea's GDP growth rate. Though growth rates vary across different industries, we believe that GDP growth is a good approximation of the long-term growth of mature industries. Our terminal value is based on the long-term cost of equity of 10.34%, but our discount factor is based on a 5-year cost of capital 10.44%. Therefore, we will get the share price of 1.236655 million Korean won.
The sensitivity analysis is derived from the key drivers in two levels. The primary consists of beta, growth, and FCFE, while the secondary inputs consist of capex and net profit margin. The graph shows that share price is most sensitive to changes in FCFE and the least sensitive to changes in growth rate. The share price is moderately sensitive to changes in beta. In addition, the results shows a positive correlation between FCFE and growth to the share price. A negative correlation is weakness between FCFE and beta, and an increase in beta will result in a lower share price due to the amplified risk. The key assumptions are as follows. Firstly, the FCFE is based on the forecasted financial statements in the DCF model as mentioned earlier. Secondly, the bottom-up beta is based on the business segments within the industry to be more representative and also to accurately reflect the risk of the firm. Thirdly, a two-stage growth model is assumed. The growth rate for the first 5 years is derived from multiplying ROE with the retention rate, which is assumed to be consistent but varies accordingly with net income and net capital expenditure changes. The ROE is adjusted based on historical trends. In the stable growth stage, the variables are assumed to remain constant and will not affect the share price. The beta is adjusted based on the outlook of Samsung's debt-to-equity ratio, and the growth is assumed to be 3% GDP growth rate in South Korea. Lastly, as the financial leverage ratio is relatively stable and low, it is assumed that the firm has reached its optimal financing mix. The results of the second analysis shows that the share price is more sensitive to the change in net profit margin and less sensitive to the change in capital expenditure. Also, there is a negative correlation between the net profit margin and capex to the share price. An increase in the net profit margin will result in an increase in the share price, while an increase in the capital expenditure will result in a decrease in the share price. And based on the results above, we have identified that the key value drivers will affect the growth. The key value drivers for the firm is through its Creative Development Research Institute system, where it provides its employees with opportunities to generate creative new ideas, further improving its productivity and innovation. Also, synergistic partnerships are key to Samsung's growth. One example is the partnership with Google. A 10-year patent deal was signed between Samsung and Google, which fostered deeper collaborations on the R&D of the product technologies. Samsung Electronics could go further by integrating its products, entering into partnerships, and engage in continuous R&D. Firstly, it could work on combining its consumer appliances with mobile communication devices further. A good start would be the Samsung Galaxy S4 that is able to control Samsung televisions. Next, it can establish partnerships with its key suppliers to further strengthen the business relationships. It could also work on supplying more parts to these partners with the partnership. Continuous R&D would also ensure that Samsung Electronics could preempt and meet market demands quickly.
For these three types of multiples as shown, our group has concluded that these multiples are not appropriate in valuing Samsung, and these are reasons to support our conclusion. Our choice of multiple is EV over EBITDA. This is due to three reasons. The multiple eliminates accounting distortion. Second, more firms have positive EBITDA values than positive earnings. Thirdly, this multiple is second most widely used by investors to evaluate. The value of Samsung Electronics is assessed at the market and sector levels with the use of EV over EBITDA multiple. Under market analysis, Samsung appeared to be undervalued relative to the market. However, firms in capital-intensive industry like Samsung will have higher EBITDA due to high depreciation expenses, and this will lead to lower EV over EBITDA. Under sector analysis, looking at the formula for EV over EBITDA, four fundamental variables are identified. They are growth rate, tax rate, reinvestment needs, and leverage ratio, and the specific proxies are selected to define the variables. In total, there are 12 comparable firms for Samsung, and they are identified by the four criteria as shown. Regression is performed across the comparable firms and Samsung, and a regression equation is generated. The R-squared value of 0.32, and this means that the four variables are able to explain the changes in the multiple relatively well. We will then input the variables of Samsung into the regression equation, and we derive the predicted EV over EBITDA value for Samsung is 8.23. Comparing to the actual EV over EBITDA of 2.4, we concluded that Samsung is undervalued.
So far, we have used two models, DCF and FCFE. We have chosen FCFE as our model because of the four reasons. Number one, we can actually foresee predictable cash flow, profitability, and cost of equity for Samsung. Number two, it is actually closest to the intrinsic share value. And number three, there's less exposure to market fluctuations if we are using FCFE. And number four, it is easier to track the free cash flow to equity shareholders. Therefore, under FCFE model, the target share price is 1.24 million Korean won per share, and the current share price is 1.13 million Korean won per share as at 30th October 2014. We would recommend a buy because the company is undervalued with an upside potential of 9%.